Legacy planning, y'all. Yes. So none other than Prophet Sherelle Meredith is going to come up now and teach us about legacy planning. Y'all have y'all notepads and pens ready to go because this is another avenue to generational wealth.
Good afternoon, everybody. Everybody doing well? Everybody doing all right? Awesome, awesome, awesome. Come on, let's give it up for our apostles. Amen. For thinking enough of us to be able to do this. And we thank God for Prophet Vic. Didn't he do an amazing job? Yes, and Dana did an awesome job on yesterday. Kayvon did a phenomenal job. And we are super excited. I'm not going to be before you guys long, I promise. Delana? Where my stuff at, shit? There you go. Girl, you know, I don't know what I'm doing. So thank God for the young people. Ah, yeah. Now what I press? Okay, thank you. Thank you. All right. So well, everybody here know who I am. So I am Sherelle Meredith. I am a licensed life insurance professional, aka the legacy planning expert. I currently reside in North Carolina, but I am originally from this great state of New York. I've been in the industry now since about 2004. I first got my first license here in the great state of Virginia. Back in 2004, I was licensed. I also held the security license as well for variable products. And I'm not interested in doing it anymore. Not that part of it anyway. So what do we do? I am a broker, which simply means I do all the shopping for my people. Okay, so I make this process very simple and very easy. And I'm going to be really short, sweet, and to the point. My why. Why did I choose to become a life insurance professional? Well, how many of you know that unlike our car insurance, unlike our health insurance, it's not a matter of if you will use life insurance, it's just a matter of when. Right? We all going to use it at some point in time. Okay? Because nobody's going to get up out of here alive. Right? So, my why is I remember when my father first bought a life insurance policy, he kept telling me, Sherelle, look at the policy, look at the policy. And I kept procrastinating. I kept putting it off. I was like, my daddy, I will. Because none of us think that our parents are going to transition anytime soon. So this was a case where I thought I was ready. Right? Because I knew he bought the policy, but I didn't know what type of policy it was. So when he transitioned and I went to pull the policy, when I called the insurance company, they said, ma'am, I'm so sorry, but this is an accidental policy. This policy is not going to pay out. He died from a heart attack. That's a natural cause. Okay. How many of you know that grief and financial stress do not go together? That is a recipe for disaster. Okay. They don't go together. So that was an instance where I thought I was ready. Then I had another family member transition, and we was not ready. Okay? And we had to depend on family members and friends to pick up that bill. And because it seemed like I'm always the one in my family responsible for when everybody die, I don't know why, but I was stuck with the bill. And I had to come up with $12,000. And how many of you know the people that do the most talking is the ones that's not going to give you no money? Then I had another family member to transition, and we was ready. Okay? The policy was there, and we was able to use it. All right? So, how many people currently have life insurance? You currently got life insurance. How many of you know how your policy works? Most people don't know how their policy works. And though if you had a good insurance agent and I explained how your policy worked, I know you still probably don't know. All right? So you want to know, one, what type of policy you have, if you have one. Two, you want to know how it's supposed to perform for you. And then three, you want your family members to know where it's at. Because we have about, statistically, it's about they say it's about $1.5 million of unclaimed insurance money. Because people just don't know how to get access to the to the policy. Okay? So let's talk for a few minutes and I'm gonna backtrack. So I call myself the legacy planning expert. Somebody tell me, what is legacy? What does legacy mean to you? What you leave behind. Okay, what you leave behind. Basically, that is it in a nutshell, right? So legacy can take on several definitions. So we leave all types of legacies behind. It can be your values. It can be your faith. It can be your assets. It can be money, right? So we leave all type of legacies behind, okay? A legacy may come from a person's character or reputation, the life that you lead, right? That's part of your legacy, okay? So what is life insurance? The little pamphlets I gave you guys is just a breakdown of what it is and what we use it for, okay? And I'm not going to ask who need it because everybody need it. If you are alive, breathing, and if you are alive and you are breathing, you need life insurance. So what is life insurance? I saw on the slide. Oh, go to the next slide. I'm sorry. So what is life insurance? It's a legal agreement between the insured, which is you, and the insurance company that specifies payment of a predetermined benefit amount upon death, subject to the terms of the insurance contract. Life insurance proceeds are generally free from federal income tax. So when you get benefits from a life insurance policy, they are not subject to federal income tax. That is a good strategy to know. And we're going to talk about strategies in a minute. Who needs life insurance? Everybody, right? And why do you need it? You want to protect yourself and your family members from what? Financial hardship, okay? And that's if you become chronically ill, critically ill, or terminally ill. So life insurance, how many of you know you can use life insurance while you're alive? And I'm not talking about doing loans and withdrawals. Because everybody know that. If you know about whole life insurance, the one thing the agent sold you on was, you know what? You could take a loan against your policy. You can withdraw against your policy. I'm not talking about that. Not quite, even though you can. Yes. So depending on the type of policy that you have, okay, and nobody should have a policy. If you cannot use that policy while you're alive, if you become chronically, critically, or terminally ill, you don't have the right policy. Sure. So the old traditional life insurance policies, if you had a whole life or a term policy, and we're going to talk about the difference in a second, you only can use it as a death benefit. So that means you never got to use the policy, only your family members could when you die. Right? Now, when it comes to a whole life policy, you can withdraw some of the money out of the policy. But as far as the policy itself working for you, you can only use it when your family members are the only ones can use it when you died. And you designate what is called a beneficiary, which is simply the person that you designate that you want the proceeds to go to when you pass away. Okay? So, did I answer your question? Okay. So, how much is, somebody has another question? No. Mm-mm. Okay, no, it's not disability insurance. Okay, how much is life insurance? Every individual is different. Here are some things you need to consider. So when you're looking to get a policy, these are the things that you need to consider. What is your current income? What is your current savings? What type of debt have you accumulated? Future education needs, financial and retirement needs, your age and your life stage. Where are you at in life? The next thing you need to consider, what I did not put on the slide, is what is it you want the policy to do? Okay? Do you want the policy just to be a pure death benefit for when you die and take care of your expenses? Are you trying to create generational wealth? Are you trying to use it as a wealth building strategy tool? What is it you want the policy to do? Do you want the policy to replace your income? Right? So here's some things. Thank you, Nadia. Here's some things that you can use your life insurance policy for. Mortgage protection. It assists with paying your mortgage payments. It assists your families with paying your mortgage payment or paying your mortgage off in its entirety. Mortgage protection is different from PMI. A lot of people don't know that. They get the two confused. PMI protects the lender. It does not protect you. PMI is private mortgage insurance. So when you get a mortgage out on your house, if you don't have a certain amount in down payment, they tell you you need PMI. They roll it into the loan, right? That protects the lender. So if something happens to you, the lender will get paid, but your family still can lose the house. Mortgage protection protects your family. Okay, so it will contribute to paying the mortgage or paying the house off. All right. Some people also use life insurance for income replacement. That's what it's majorly used for. So whoever the primary breadwinner is in the house, right? If something happens to them, you want to be able to replace that income so that you do not have to change your standard of living. Okay. Estate planning is another tool that life insurance is used for, and that's a whole nother topic. And then charitable giving is another reason people get life insurance, because they want to donate to their favorite charity, but it's also used for tax benefits. Okay, so this is, I want you guys to picture a house. What is the most important part of the house? Say it. The foundation. If the foundation is not built right, what happens to the house over time? It begins to crumble. So I want you to picture your financial house. Picture your finances as a house. The foundation of the house is, of course, your income, the money that you earn, right? And then it's your savings, right? So everybody should have anywhere between 3 months to a year worth of savings sitting in the bank account. Right? Preferably a high yielding bank account if you can, because you're going to get more interest than you would if you just leave it in a regular account. Okay? And then your life insurance. Life insurance should be just as important to you as your utility bill. Because what it says to your family members, how much you really care about them. That you don't want to leave a financial burden on them. That is part of creating and leaving generational wealth. So how is life insurance priced? I want y'all to think about this. Life insurance is priced according to your age. So the older you are, the more it's going to cost you. It is priced according to your health. The more health conditions that you have, the more it's going to cost you. Now, there used to be a time that if you had certain health conditions, you was considered to be what we call uninsurable. Okay? That is not the case anymore. We can get you coverage regardless of what your health issue is from age 0 to 85. Okay? It is also priced according to gender. Males' premiums are usually higher than females. It is also priced according to your lifestyle. So, believe it or not, if you have a reckless driving record, that will increase your premium. You know why? The insurance company is all about risk. You are considered high risk if you have a reckless driving record. Because to the insurance company, there is a higher chance that they have to pay out a death benefit a whole lot faster. Right? So all of it is connected. So that's the way they price your life insurance. So I get a lot of people say, oh, I want $100,000 life insurance. And you 60 years old. You know what that premium look like? Even in the best of health. You talk about a $250, $350 something premium. Just because of your age alone. Right? So the younger you are, the cheaper or the less expensive it's going to be. Okay? Who have policies through work? Who have a policy through their job? Okay. You used to have a policy through your job. So let me explain to you something about policies through your job. You don't control that policy. Another thing about a policy through your job is if you miss work for more than 2 consecutive payroll periods outside of being on vacation, that policy will not get paid. And it will not pay out to your family members either. Why? Because it is considered an active payroll deduction. So I'm out on FMLA right now. Guess what? My policy at work, I've been gone longer than 2 payroll periods. Thank God I got a policy outside of work. So God forbid if something was to happen to me, my children and my husband don't have to do no fish fries or no GoFundMe's, right? So that is something I always tell people that say, oh, well, I got life insurance to work. That is good. Keep that policy because it's cheap. The premiums are very little because it's a group policy. So you have a lot of people on that policy, right? But make sure you have a policy outside work that you can control. Another thing about work policies, if you become chronically ill, guess what? That policy is not going to pay. Now, if you got short-term disability and you home for 30 days or more, you'll get some money. But outside of that, your life insurance policy is not going to pay. Okay? So you want a policy that you control and you know exactly what's going on. All right? So we talked about what life insurance is. We talked about the way it is priced. Okay? Now, this is a question I get all the time. Sharon, what is the best life insurance policy? The best life insurance policy is the policy that you can get qualified for. I'm not going to keep it real. For real. That's the best. Because that's the best for you. You understand what I'm saying? Now, I may write Prophet Vic a policy and write Pastor Sholana a policy, and she may find out what he got and want it, but if she can't qualify for it or can't afford it, that's not the best for her. Okay? What's the worst type of insurance policy? The one that's not enforced when you need it. When your family need it. That's the worst. You can go to the next slide. Okay? That is the worst. So let's talk about types of insurance. And I'm going to breeze through this real quick. If y'all got questions for me afterwards, I can go into more detail, but we're going to breeze through this real quick. So there are 2 types of life insurance policy that we hear often that's sold around in the industry, and you hear something that's called term. Term is exactly what it is. It's temporary. It is for a term. It could be a 10-year term, 20-year term, 30-year term. Okay? It is termed. So that means after whatever term you chose, at the end of that term, you no longer have insurance or you can renew it. But keep in mind with term policies, 1, they have no cash value. 2, when you go to renew the term, you are now older and you have to prove insurability again, which means you got to requalify. And guess what? That premium is about to do what? Increase. And it's probably going to double or triple. Okay? Why would I buy a term policy? You buy term policy, they do have their place. So don't get me wrong. If you are young and you have a family member, when I say young, 40 or younger, and you have a family member, you have a family, you own a house, you are the primary breadwinner in your house, but you don't have a whole lot of income, but you need a lot of face amount. That's when you'll get a term policy. Okay? So I'm 30 years old, I'm married, I got children, we own a house. You may not own a house, we paying rent, but you know what? My husband or my wife is the primary breadwinner, and if something happens to them, we're going to be up a creek without a paddle. At 30 years old, get a term policy. Okay? Because now at that point, you can get $300,000, $400,000, $500,000 in insurance, even $1 million in insurance, and the premium is going to be fairly low. Okay? That's when you will buy a term policy. Or you buy a term policy if you own a house and you just want to use it strictly for mortgage protection. Mortgage protection policies are a type of term policy. Okay, there are two types. You can get a level term policy, which means the death benefit or the face amount, and the premium remains the same throughout the term. Okay, or you can get what we call a decreasing term, which most people have to cover debt. All right, if you're trying to cover debt and that's all you want it for, well, then your premium will remain the same, but every time you pay down that debt, the face amount will decrease until you get to zero. Y'all got that? Everybody understand that? Okay. Okay. So decreasing term policies are used to cover debt only. Most people, when you go to buy a car, they include a term policy attached to it. And it's usually a decrease in term policy, right? And everybody that got a car, you paying a car payment, you need to know if you got it. Okay? God forbid you transition, okay? That term policy will pay off that car so that debt is not transitioned to your family members. But the caveat is this: the premium remains the same. So if they're taking, say, $100 out of your car payment to put towards that, that's going to stay the same, okay? Until either you transition or the car is paid off. But it's going to decrease every time your debt goes down. Y'all got that? That's called a decrease in term policy. If you own a house, I would not recommend a decrease in term policy. I would recommend a straight level mortgage protection policy because you get the entire face amount. So now you're not necessarily throwing away money if you transition. So say you have a $500,000 mortgage protection on your house, you transition, your family get the entire $500,000. Okay? You follow me? Okay. All right. So that is the difference. Then we have something that's called an annual renewable term, which just simply means that every year during that term, the policy will renew without you having to prove insurability again. All right. And then the last one is a return of premium term policy, which that simply means is if you have a term policy, you never let it lapse. The insurance company will give you back all your money that you paid during the entire term. So if you have a return of premium policy, say you had a term policy for 20 years, you got it when you was 30, you are now 51, you have outlived the term. They will give you back all the premiums that you paid from the time you were 30 up until you was 50, as long as you did not let it lapse. If you get one lapse, that rider is void. Because it is a rider, and you're going to pay for it, but they're going to give you all the money back, but you cannot let the policy lapse. Okay? If you let it lapse, that's it. All right, let's go to the next one. Whole life. Whole life, everybody knows about whole life insurance. It is permanent coverage, right? So whole life insurance usually lasts up until the person is 100. Now that a lot of insurance companies are covering people up to the age 105, 121, okay? Because the life expectancies are longer, all right? If the person has an insurance policy, I'm just throwing out a number, say it's $100,000. You bought the policy when you was 40, you paid your premiums, you never let the policy lapse, you turn 100 years old, for a straight whole life policy, they will give you the whole $100,000. Okay? Plus, but with straight whole life policies, this is the trick question that everybody asks. Well, I paid all them premiums and I got cash value in there. Do they give me the cash value and the $100,000, the face amount? In this case, we're gonna say $100,000. No, you're gonna get the $100,000 because in that case, the cash value is gonna be less than what the face amount is. Y'all follow me? Okay, so they'll just give you the straight $100,000. That's what we call a straight life, whole life policy. Most of those policies, they accumulate about 3% interest. Okay, and before you see any type of real cash built up in it, you usually have to keep the policy for 3 years or more. Because if you try to get money out of it before then, surrender charges and fees and all that stuff is going to eat you up. Okay, we can go to the next one. So the next one is, it is called a universal life policy. It is a type of whole life policy. Okay, it is a type of whole life policy. Universal life policies, a lot of people like them because you can adjust the premium and the death benefit. It's flexible. The premium is what you pay. The death benefit is the amount of insurance that you have. So if you have a $100,000 policy, that's what your death benefit is, or your face amount. It means the same exact thing. Okay. So with a universal life policy, it's flexible. You can, adjust the death benefit. You can adjust the premium on how you're going to pay it and the amount that you're going to pay. You can adjust all that. Just keep in mind, though, if you miss the payment, you got to have enough cash value in there to cover it. If not, the policy will lapse. Okay? Another type of universal life policy, and this is the buzz going on right now. Dr. April was asking me about this yesterday, so I'm going to answer your questions. It's called an IUL, Index Universal Life Policy. You hear a lot of people say, be your own bank. A lot of people talk about infinite banking, right? That's the buzz going on right now, right? How are they doing that? They're doing it through an Index Universal Life Policy. So what is the Index Universal Life Policy? An Index Universal Life Policy is tied to an index. Somebody give me a name of an index. What's one index everybody know? Nope, stock market ain't the index. S&P 500, right? Everybody knows the S&P 500, and there's a couple of them out there, but the S&P 500 is the one that mostly everybody know, right? So what the IULs are is they have two components, which is your cash value and your death benefit. But they have three elements. The three elements is the premium that you pay, the death benefit, meaning the face amount. We're going to keep using that $100,000 as an example. And then the cash value. Okay? So, how many of us heard of the Rockefellers? Everybody know who the Rockefellers is. How many of us heard of the Vanderbilts? Everybody know who the Vanderbilts are? Okay. Remember I told you earlier that life insurance can be used as a generational tool? That's what the Rockefellers did. The Vanderbilts and the Rockefellers both were wealthy families. The reason why the Rockefellers are still one of the most wealthiest families today is because they use this type of policy right here. An Index Universal Life Policy. This is what they did. They took out a universal life policy on every child that was born in that house. Every child that was born in the Rockefeller family has an IUL. Okay? From the time they are born, they take out this type of policy. Here's why. the government allows us to fund this type of policy. You get to fund a certain amount of money in it every year, right? And as you fund the policy, it accumulates cash value. So the more money you put into the policy, the faster the cash value grows. So say if my premium for $100,000 IUL, I'm just throwing out a number, say it's $110. But you are 38 years old. Our rule of thumb is however old you are, put a zero behind it, and that's how much you need to put into your IUL. Okay? So that additional $200 and something, right, that you are putting in the policy is helping your cash value grow at a lot faster rate. Okay? So this is the way it works. With an index universal life, what the insurance company says is this. You have a floor and you have a ceiling. The floor is the minimum guaranteed contract rate of interest rate rather. So the insurance company may say, we guarantee you 4% interest in this policy. And they get to determine what the ceiling is. And they may say the ceiling right now is running between 8 and 12%, depending on what insurance company it is, right? If the index is performing poorly and it drops before that 4%, you still going to get that 4% because that is the floor. They're telling you we're not going to go below that. But now when it's performing good, you're going to get that 12%. How many of you heard of the rule of 72? How many know what the rule of 72 is? Go ahead. You were saying something, Dan. You know what it is? Okay. So the rule of 72 is this. The rule of 72 tells you how long it's going to take your money to double. This is what the banks do, y'all. The banks take the money that we put in our accounts. I hope y'all don't think it just sit there. Okay, y'all know it don't just sit there, right? They invest your money. Okay? So the rule of 72 is this. So if I put $1,000 into an account and I have an 8% interest rate, if I take 8% and divide it by 72, what number is that? 9. So that means it would take 9 years for my $1,000 to become $2,000. Oh, you think that's a lot? So take what the bank is giving you, and they're not even giving you a full 1%. So if you took that $1,000 and put it in that same account with a 0.5 interest rate, and that's high because they ain't even giving that, most of them, okay? It's going to take over 72 years for your money to multiply. Which your money is not keeping up with inflation. So what an IUL is, it's a hedge against inflation, right? Because when it's doing well, they're going to credit you that money. Okay? But when it's performing low, you're not losing anything. Okay? So what the Rockefellers did was they funded that policy and they let the money grow in the policy. And then what they did was they took loans out against the policy for 2 reasons. One, you don't have to pay it back, but if you were smart, you would, because your money is still compounding. That's number one, which means it's still growing. But number two, the reason why they took the money out of the insurance policy, who can guess? Yeah, but why? Why did they take it? Was for investment purposes, but why did they pull it out the insurance versus it's a tax strategy? They pull that money out tax-free. And they kept that cycle going year after year after year after year. Correct. Absolutely. So we know the saying is not what you make, it's how much you can keep. Right? And now it's not so much how you can keep, but how fast you can grow what you're keeping. How fast can you grow it? That is the key. So that is the reason why people do IULs. Now, I'm going to tell you the caveat to the IUL, because I'm very transparent. The caveat to the IUL is, one, it has to be funded right and set up properly. The second thing is you have to have the discretionary income to do it. Because if you're trying to fund this policy and you want to go in and pull money back out of it fast, this is not going to work for you. It is a long-term investment. You got to give the money time to grow. Okay? So when I sit down with people, I look at your discretionary income, and discretionary income is just versus what your income is versus all of your liabilities. And if you don't have at least 3 times the amount of what your liability is in discretionary income, the chances of me writing you this policy is slim to none. Because I'm setting you up for failure. Because I know you're going to need the money. And you're going to try to go get it. And then when your money don't grow as fast, then you're going to come back to me and be like, no, because that ain't what I told you to do. I told you to work. Okay. You got life insurance on your kids. Do not add them to your policy as a rider. Don't do it. Because here's why. You negate all of the living benefits for your children. A rider is nothing but a pure death benefit. And then guess what? After they turn 25, that's it. They drop off anyway. Okay? So don't, or you turn 65, whichever one comes first. So don't add children as riders. Get them their own policies. All right. And they're very cheap too. So the other type of policy that, another type of universal life policy, you may hear this one too. Back in the early 2000s, this was the buzz, VUL, called Variable Universal Life. It works just like the IULs, except it's tied to something different. It's tied to the stock market and mutual funds. Okay? If you are young, and when I say young, I'm talking 30 or less. Okay? And you want to do a VUL and you have the discretionary income to fund it properly, go for it. They put your money in sub-accounts. Okay, they diversify your money into different mutual funds. But here's the caveat. You take all the risk. Guess what, guys? Same way in your 401k. If you have a 401k, you take all the risk. If you have a 403b, you take all the risk. So what it means is if this, because your 401k, your 403b, all of your IRA, your Roth IRA, all of that is tied to the stock market. So if the stock market is doing good, you make money quick. But the minute it crashes, you lose everything you had in the accounts. Right? So what I like to tell people is if you're 30 or younger and you have that discretionary income, go ahead and do the VUL. I can't write it because I don't have a security license no more. And not interested in getting one, so don't ask me. Okay? But you can do the VUL. All right? And then after you accumulate a certain amount of money, pull the cash value out and then go put it in an IUL. No, there's no penalty. It's tax-free. It is not tax deferred. That's what you reference when you ask me, is it a penalty? Penalty. Tax deferred. 401k, tax deferred. 403b, tax deferred. IRA, tax deferred. Roth IRA, tax deferred. The difference between a Roth and an IRA is only one thing, and that's the age difference. When an IRA, they make you pull it out between 59 and a half. A Roth, you can keep it in there till you're 72. That's the difference. But they both are tied to the stock market. So if you're young, those accounts are great. But then pull the money out once it grows to a certain amount and put it in an IUL. Okay? So that's how you protect your money. So that's a variable universal life. Let's go to the next one. GUL is guaranteed universal life premiums. They are smaller face amounts. They are level premiums. That means that the premium just don't change over time. They are not tied to no stock market, no mutual funds, or an index. They have a general account just like a straight whole life policy. And then the last policy is a final expense. You would do a final expense policy if you are over 45. Okay? You over 45 and you just trying to leave a pure death benefit, which simply means this. I just want enough money in the policy that my family do not have to do no GoFundMe's. They do not have to do no fish fries. It's going to cover all of my final expenses. Your funeral, cremation, burial costs, flowers, the obituary, stuff like that. Okay? Or any type of medical bills. Those policy face amounts are usually anywhere between $5,000 and $50,000, just depend on what you need. All right? So people have all types of insurance policies. It depends on what you want the policy to do. All right? So everybody's situation looks different. Okay? Because some people policies, they want to leave a bunch of money behind. Some people saying, no, I have other assets that I want to leave my children or my family members. So all I need is a final expense policy. I don't need a big, huge policy. Okay? But you need to know what the policy is doing. You need to know how your policy works. And your family needs to know you got a policy and they need to know where it's at. And if you don't have one, you need to get one ASAP. Let's go to the next one. Did I finish? Was the last one? Oh, no, was it? Okay. Anybody got any questions before we move? We got 2 more topics to cover and then we're going to be done. Yes, ma'am. You need to know how financially disciplined he is. Okay. So if you're going to be doing it, you can do a VUL for him if you have the discretionary income to fund it right. Okay? Okay? Yes, ma'am. Okay. So benefits that you could use while you're living in your insurance policy. Regardless of the insurance policy you have, whether it's term or whether it's whole life, okay, you should have what we call living benefits in the policy. Living benefits simply just means you can use the policy if you become critical, chronic, or terminally ill. And the insurance company says we will advance you anywhere between 20 up to 50% of your death benefit. Some of them will advance more. It's an advance, and they subtract that from the death benefit. So if you got $100,000 policy and you had to use $50,000 of it while you are alive, then your family members only got $50,000 to work with. Yes, sir. Oh. Okay. Anything else before we move to the next one? Y'all good? All right. We're going to talk about forms, and then the last, it's up there. Okay, we're going to talk about forms, and then the last thing I'm going to talk about is a will versus a trust. Okay? So forms. These are some forms that everybody need to have. And if you don't got them, get them ASAP. I've been working in the medical field well over 30 years now, and I can tell you, I have seen some disastrous family fallouts. Okay. When people are sick, when people die, family act a fool. I'm just keeping it real. They act a fool. Everybody know what mama wanted, but nobody was there to help mama. Well, mama told me this year. She told you that 10 years ago. Because the last 10, you ain't been nowhere to been found. And even if she told you that. Well, daddy said he want this. No. All right. Or if you like me and you have a blended family, that gets real funny when people die. Right? Because then everybody, that's my daddy, that's my mama, and I know what she's. No, we ain't gonna do that, Suge. Okay, so here we go. Write these down because these are some everybody need to have, married or single. You need to have them. The first one, a healthcare power of attorney. Everybody need to have one. You can get them from your local hospital, or you can download it for your state. Yep, healthcare power of attorney. Everybody need to have one. The second one is a financial power of attorney. Or you could do something that's called a dual power of attorney, which covers both health and finance. Okay? So here's the reason why you need it. Healthcare power of attorney, you want to have it because God forbid you come incapacitated, you're not able to make healthcare decisions for yourself. You're not able to talk. Somebody need to be designated to talk for you. And spouses, let me give y'all a rude of awakening because I've seen this happen too. Just because you married does not mean you get to say. And most people think they do. Well, that's my husband. But guess what? If you don't have a healthcare power of attorney in place and they got some kids that want to go up against you, that's going to be a problem. Okay? And it just all depends on what hospital you in and what doctor you get. I've seen it happen. Okay? Financial power of attorney. If you are married, but you guys have individual accounts, or if you're single and you are the sole person on your account, you need a financial power of attorney. Because guess what? Or even if you have 401ks or 403bs, IRAs, Roth IRAs, right? Any type of financial anything, you need to have a financial power of attorney. Now, for married people, if you have a joint account, when it comes to your bank account, it's not a problem. But guess what? If your spouse have a 401k, you're not on that account. And you're going to try to access that money and you won't be able to. You will have to wait until 30 days after you produce the death certificate. And the 401k and all those other accounts can be added into the person's estate. And if you get into some type of battle and now you got to go to court, guess what's going to happen? It goes to probate. And we're going to talk about what probate is in a minute. Okay? So you want to have a financial power of attorney. Another thing you want to have on your bank accounts is called a pay on death designation. Pay on death designation. You want to have that on your bank account. So when you go to the bank, ask them to give you a pay on debt designation, or be sure that you have a beneficiary listed on your bank account. If you have 401ks, 403bs, things like that, you definitely need a pay on debt designation form. Okay? Then you want to have what's called a transfer on death. What that simply means is that works for like most vehicles or non-qualified brokerage accounts. Okay? It's called a transfer on death. Some states don't recognize it, but the state of Virginia does. Vehicles or non-qualified brokerage accounts. Yes, ma'am. No, the transfer on death, the pay on debt is done with the bank, or you can just go to the bank and list what's called a beneficiary. Okay? The transfer on death, all right, is usually used for vehicles or non-qualified brokerage accounts. And you can get that form from your lender, whoever you got a car note through, if you got a car note. We're going to talk about it in a minute. Okay? So for real estate, it's called a beneficiary deed. It's called a beneficiary deed. It has the same concept, but it's called a beneficiary deed. Now, if you are married and one person passes, then of course the spouse will automatically get the house. But say, God forbid, they're in an accident and both spouses pass away, right? If you don't have a beneficiary on deed listed on your property, again, it's going to get tied up more than likely in probate. Okay? The one thing you need to know about probate, you need to know your state threshold, your state's probate threshold. For the state of Virginia, it is $50,000. So what that simply means, if you have any assets, $50,000 or more, which is going to lead us into our next and final section, you can get tied up in, your assets can get tied up in probate. Okay? Any questions there? No questions? Okay. So leading to our next and final section is will versus a trust. How many of y'all know what a will is? Everybody heard of a will, right? Or last testament, same thing. Okay? It's a document that you create advising how you want your assets and property be distributed when you pass away. But remember this though, you can create the will, and the will don't necessarily have to be created by an attorney. You can download the paperwork for your state, create the will, and have it notarized, and you have a will. Okay? But there's a problem with a will when you start talking about property and large amounts of life insurance, large bank accounts, large investments. There's a problem with a will. One, it can go to probate, and probate is just the court's public planning estate process is what probate is. Okay? But the court can also decide that a will is not legally valid, and they can rearrange your desired distribution of your assets and your property. Because they have the authority. They can do it. They have the authority to do it. This is the reason why if you have property, you do not want to do a will. If you own property, do not waste your time doing a will. Okay? Do a trust. Okay? Do a trust. Okay? Don't waste your time doing a will. All right? So let's talk about a trust for a moment. So a trust must be set up by an attorney. Okay? So it's going to cost you something. It's going to cost you a little bit of money. But a trust must be set up by an attorney. The trust ensures that your assets are managed according to your wishes during your lifetime and after. Okay? You have two types of trusts. You have what's called a revocable trust and a irrevocable trust. A revocable trust gives you the authority to go in and change it at any given time you want to. So say you had John Boy get in the house. John Boy done piss you off. And now you want Sally to get the house. So now you're going to change it. And you can say the house go to Sally. You can put that in your trust. Right? There's a trustee that will execute the trust. Okay? But you have total control over it. All right? Then you have something that's called an irrevocable trust. Which means once you set it, that's it. You can't go back and change it. Okay? So again, if you have property, do not waste your time doing a will. Go ahead and pay the trust attorney to set you up what is called a living trust, and go ahead and get a trust. And like I said, it's going to cost you a little bit of something, but it's going to be worth it in the end. Give me 1 second. You sure can. I just want to say this one more statement before I forget. The trust also hides your assets from public access. That is the reason why a lot of people put things in trust. Because guess what? In a will, say I get left a house in a will, right? And I'm married and I get a divorce. and say that house is worth $250,000. That $250,000 now does what? It goes against my income. Okay? So guess what now happens? That house get tied up in probate because I'm in the middle of a divorce. So that's why you don't want to do a will. If it's in a trust, they can't touch it. Somebody sue you. They can't touch it if it's in a trust. Okay? I'm going to give a disclaimer. By no means am I giving you legal advice. When you are dealing with a trust, I want you to go to a trust attorney. Is that understood? Okay? Because they're going to give you the details. I'm just giving you the basis of it and the reason why you want to do a trust over a will. Now, if you don't have no, you don't have no property, you got a little something in the bank, it ain't much. You could do a will in the beginning, but as you begin to grow, you want to look at doing a trust. It is well worth it. Okay? All right, Pastor Brackton, what was your question, Don? Yes, ma'am. Mm-hmm. When you say gone, you mean transition? Oh, yeah, you can do it then. Oh, guys, I'm glad you said that. Another thing, too, the same thing with your life insurance. You can do a designated beneficiary, but if you do paperwork and have somebody on your life insurance as an irrevocable beneficiary, you cannot change it no matter what happens unless they agree. If you have a life insurance policy, so this usually happens with spouses, right? This usually happens with spouses. And they list their spouse as a irrevocable beneficiary. And they get a divorce. And they say, I no longer want you to be my beneficiary. Guess what? If I don't agree, it ain't nothing they can do about it. So you can go get married 10 times after. When you die, I'm still going to collect. That's just the truth of the matter. That's where it works. It's good. So this is where we get into estate planning. And I can't go into detail right now because we ain't got enough time, but I will give you the surface of it. When you create the trust, the lawyer will have you list out how you want the people to be listed and who get what. It's called contingency. Okay? So they will have you list out who's primary, who's contingent. And they'll have you keep going down the line like that. I will give y'all this one nugget though. If you decide to do a trust, when it gets to your contingency portion, a lot of people make this mistake. They disinherit their grandchildren by mistake. Because they only list the children. And if that child dies, the money goes back into the estate. Right? The grandkids get disinherited by mistake because it's the way you listed it. So you want to make sure that if you're doing a trust, when you talk to the trust attorney, you want to make sure that everybody is listed. See, that's another thing the Rockefellers did. So they never lost no money when they start dying off. You understand what I'm saying? So April said something that made sense yesterday. Own nothing. And this is what a trust says. I own nothing, but I control it all. That's what a trust says. So you come to sue me, my house is in the trust, my car's in the trust, my business is in the trust, everything in the trust. It look like I ain't got nothing. Yes, ma'am. It is good. Mm-hmm. Of course you can. No, you can still put it in the truck. Yeah, you can still put it in the truck. Yes, sir. It's not showing that you have any assets or anything like that. So the trust, whoever is the executive, well, that's the executive of your will, whoever is the person that's helping, the attorney that's helping you set up your trust, they'll show you how to get those assets to put it under the trust as well. They'll show you how to do it. Okay, because it is a technique. And that's what a lot of wealthy people do. They accumulate all of this stuff, but it looks like they don't own anything, but behind the scene, they're controlling it all. And they're controlling it through a trust. Okay? Yes, Nadia, I told you. No, no. This is going to cost you a couple $1,000s, but it's worth it. It's the best investment as far as I'm concerned. It's one of the best investments you can make. It's worth it, especially if you one that you know you want to keep accumulating. You understand? Yeah. Any other question? No other question? Well, thank you guys so much for your time. And if if you want to set up an appointment with me, on your folders there is a QR code. You can just scan the QR code. Mostly everybody here though got my phone number. Or you it's a QR code. You can scan the QR code and get on my calendar. And I will be more than happy to sit down with you. Again, remember that insurance is customizable. It is based on everyone's individual needs. And I will say this, please, 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 do not let the fear of what type of policy you can get keep you from getting nothing. Okay? Because something is better than nothing. And you can get as much insurance as you can afford. Okay, there's no limit to where you be like, well, no, I can't do nothing now because if I do this, then it's going to stop me from doing this. No, that is not the case. So don't let the fear of not getting what you think you want cause you not to get nothing, because one thing for sure, okay, none of us going to make it up out of here alive. So it's not like car insurance if you're going to use it. It's not like health insurance if I get sick. All right, it's all a matter of when. And because we don't know what day it is, and we all as believers confess long life, right? We do, right? Ain't nothing gonna happen to me. I'm gonna live a God gonna satisfy me with long life, right? And I believe He is. Okay, I honestly believe that. But again, because insurance is based upon age, you need to do something now versus doing nothing and wait until later. Okay? Thank you. Thank you. Thank you.
All right, all right, all right. Thank you, Prophet Sherelle. How many of y'all enjoyed that legacy planning? Today was an amazing day, wasn't it, y'all? From Kevon Purdy, the licensed clinician this morning, breaking down the mind of the man and so much with the mental health. That was a lot of nuggets. And then, of course, our very own Prophet Vic regarding the intersection. I almost said intersectionality, but intersection of God and therapy. That was amazing. And then, of course, we just had Prophet Sherelle regarding legacy planning. Today was great. And also just a recap from yesterday. Again, Dana, one of our amazing licensed clinicians with mental health. Not tooting my own horn, beep, beep. Giving y'all a few financial nuggets for prosperity. And then tomorrow we have the amazing, anointed, prophetic apostle Adrian James is in the house, y'all. All the way from North Carolina. Welcome, welcome, welcome into our home. But I also want to acknowledge still the man and woman of this house, our apostles, Dwayne and Brenda Ward. I don't know where Apostle Dwayne went, but he was just in here. So we are still excited. Keep that momentum of your mind and bring that in here tomorrow. And we're going to show Apostle Adrian James and her family the same honor and respect that you gave all of us this weekend. All right. Love you all. We are dismissed. See y'all tomorrow.